The income statement measures the operating performance of a firm for a particular period of time.
Net income is derived by subtracting expenses incurred in manufacturing goods or providing services from revenues received for the goods or services. The difference is what the firm earns, or its net income. Right answer. Revenues increase shareholders' equity when an asset increases or a liability decreases as goods or services are provided to customers. Right answer. Expenses result as assets decrease or liabilities increase in the process of generating revenues. Expenses are either matched with specific revenues or recognized in the period in which they are incurred. Correct.
Dividend distributions do not represent assets used in the pursuit of revenues. It is not necessary for a company to pay dividends in order to earn revenues. Yes, financial analysts would agree that the accounting period should be consistent.
A fiscal year is the accounting year between two balance sheet dates. Most companies use a calendar fiscal year. That is, their fiscal year ends on December 31st. Alternatively, a firm may use a natural fiscal year, whose closing date coincides with events more closely linked to the events of the firm's operating cycle. For example, some retailers use January 31st as a convenient end to their fiscal year because holiday sales and post-holiday sales have just ended and business is at a low point.
For many companies, the fiscal year contains more than one operating cycle, but for some companies, the operating cycle extends beyond 1 year. Examples of companies whose operating cycle is less than 1 year include fast food franchises, automobile manufacturers, and retailers. Examples of companies whose operating cycle extends beyond 1 year include shipbuilding, liquor distillers, and tobacco companies.
We have with us here the chief accountant of Black Jensen Distillers. Tell us, does the fact that your operating cycle extends beyond a single accounting period create a problem?
Not really. Our situation is not that different from other companies whose operating cycle is less than 1 year. You see, seldom will all transactions be complete at year-end in either case. We follow GAAP guidelines here and use the accrual accounting method. At year's end, we update our financial records to show effects of incomplete transactions. The goal of accrual accounting is to recognize revenues when the firm sells goods or renders services and to associate or match the expenses incurred in generating the revenues with them. As a result, our financial statements provide a fairly accurate picture of our revenue streams and the expenses entailed in generating them.
Revenues may be thought of as the goal in a profit-oriented company. Revenues are increases in shareholders' equity that result from a company's ongoing business operations, such as providing goods or services to customers over a specific period of time. Either assets increase, liabilities decrease, or a combination of the two occur when companies generate revenues.
According to the accrual accounting method, revenue is recognized, that is, recorded in our accounts, when all or most all of services have been performed. There is a reasonable assurance of receiving a future economic benefit, such as a cash payment. Often, revenue is measured by the amount that assets increase as a result of providing goods or services to customers. Usually, there is an agreed-upon price which might be reduced because of sales discounts, estimates of uncollectible accounts, or long-term payment agreements. STAR allows a long-time customer to make 36-month installment payments on a major purchase. STAR has completed delivery of the product to the customer and has no further obligation to the customer. Should we recognize revenue? Correct. The two conditions for revenue recognition appear to be satisfied. The earnings process is complete, and long-time customers usually pay their bills. At what amount should the revenue be recorded? Very well done. This was tricky. Revenues are measured by the increase in assets, and assets whose benefits extend beyond 1 year are measured at the present value of the future cash flow.
Expenses are the decreases in shareholders' equity that result as a company pursues its goal, revenues. In order to achieve revenues, assets must be used up or liabilities incurred, or a combination of the two.
Expenses are categorized traceable to revenues or not. Those expenses that are readily traceable to revenues are matched to or deducted from the revenues in the same period in which the revenue is recognized. Those expenses not readily associated with a revenue are deducted from overall revenues in the period that the expense is incurred.
Right answer. Expenses may be measured by increases in liabilities and decreases in assets.
Expenses are expired assets, that is, assets used up in the pursuit of revenues. This would seem to imply that the basis for expense measurement is...
Right answer. Expenses are measured by the value of the assets given up or to be paid out in the future.
As assets are used up in the pursuit of revenues, what are the other balance sheet impacts?
Well done. The decrease in assets is matched by a decrease in shareholders' equity without a change in liabilities to maintain the fundamental accounting equation. Let's explore the effects of a transaction that begins in period 1 with the receipt of an order and ends in period 4 with collection of the sales price. In the first period, the company receives an order for $10,000 of its product, but these goods must first be made, then delivered to the customer. The company president's salary is $2,000 per period and is paid in cash.
What amount of revenue should be recognized in period 1 and why?
Very good. Revenue is recognized when earned and the amount to be received is reasonably assured.
You are correct.
In the second period, the company manufactures the product, incurring $5,000 of cash costs for materials, labor, and overhead. Once again, the president is paid $2,000 salary. How much revenue is recognized in period 2, and why?
Sorry, try again.
You are correct.
What happens to the $5,000 that was spent to make the product in period 2, and why?
You are correct. You are correct. You are correct.